The collapse did not come with an explosion. There were no factory shutdown sirens, no emergency press conferences, no dramatic headlines announcing the end. Instead, it arrived quietly, hidden inside quarterly reports, internal memos, and one sentence that should have shocked the entire industrial world. Our business model no longer works in its current form. Those words were not spoken by a failing startup. They were written by the CEO of Porsche, a company built on control, precision, engineering discipline, decades of financial stability. And yet, within less than a year, Porsche's operating profit collapsed by nearly 99%, from billions to almost nothing. This is not a story about a car company losing money. It is a warning signal. Because when one of the most disciplined, prestigious, and profitable industrial brands on Earth breaks down this fast, the problem is not management. The problem is structural. The world did not suddenly turn against Porsche. The world changed faster than Porsche could adapt. And this story is not just about Porsche. It is about what happens when legacy industries collide with a new technological order driven by software, artificial intelligence, energy economics, and geopolitical power shifts. For decades, Porsche represented a formula that seemed unbreakable. Build exceptional machines, control production, limit supply, charge a premium, protect the brand. That formula worked for a very long time. From the iconic 911 to race-winning engineering, Porsche was not just selling cars. It was selling identity, heritage, precision, and trust. Customers did not simply buy performance. They bought confidence. The company mastered vertical integration, manufacturing discipline, predictable margins. At its peak, Porsche generated around 18,000 euros in profit per vehicle, an extraordinary number for an automaker operating at scale. The company was not the most luxurious, it was not the most exclusive, but it was one of the most profitable. That balance made Porsche nearly untouchable, until it wasn't. By 2025, something broke. Operating profit fell from over 4 billion euros to roughly 40 million euros in just 9 months, a 99% collapse. At the same time, global deliveries declined. Revenue dropped by billions, and one market, more than any other, began to crack: China. For years, China was one of Porsche's strongest growth engines, a rising upper class, strong appetite for luxury, brand recognition. Then, almost overnight, deliveries in China fell by more than 40%. Not because Chinese consumers suddenly became poor, but because their preferences changed. Chinese buyers started choosing technology over heritage, software over symbolism, value over legacy. And most importantly, they started choosing domestic brands, brands that did not exist 20 years ago. Brands like NEO, Zeekr, Xiaomi, and others. Companies that understood something the Western luxury industry underestimated. In the electric and intelligent vehicle era, the car is no longer defined by the engine. It is defined by software, artificial intelligence, user interface, digital ecosystems, continuous updates. In this new paradigm, mechanical excellence alone is not enough. A beautifully engineered vehicle without competitive software is no longer a premium product. It is an outdated one. And this is where the deeper problem emerges. Porsche did not simply misjudge the EV transition. It misjudged the nature of the transition itself. Electric vehicles are not just cars with batteries. They are platforms. They are data-generating systems, AI-enhanced machines, rolling computers connected to digital infrastructure. Chinese manufacturers understood this early. They built vehicles around software first, hardware second. They integrated artificial intelligence into driving systems, interfaces, personalization, and efficiency. And they did it at a fraction of the cost. A vehicle that offers advanced software, strong performance, quiet cabins, and long range, and for $40,000, breaks the luxury logic entirely. Heritage cannot compete with algorithms, at least not on price, and not at scale. Meanwhile, Porsche faced another problem. The EV transition is expensive, extremely expensive. Battery production, factory retooling, supply chain restructuring, energy infrastructure. Over 2 billion euros were invested in new production capacity alone. Long-term investments that make sense over decades. But markets do not wait decades. At the same time, global economic pressure increased. Trade restrictions, tariffs, geopolitical friction. Import duties alone were projected to cost Porsche hundreds of millions. And when you combine massive capital investment with declining demand and shrinking margins, the math stops working, even for Porsche. This is the moment where many observers stop. They call it a bad cycle, a temporary downturn, a rough transition. But that interpretation misses the real signal. What is happening to Porsche is happening to the entire high-performance luxury automotive segment. Ferrari, Bentley, Mercedes-AMG, BMW. All of them face the same challenge. Electric platforms require enormous upfront investment. Software development is costly. Margins are under pressure. Competition is global. And for the first time, Western brands are not automatically the technological leaders. China is no longer catching up. China is competing, and in some domains, leading. This is not just an automotive story. It is a geopolitical one. For decades, industrial power flowed in one direction. Innovation in the West. Manufacturing spread elsewhere. Brands retained control. That world no longer exists. China has mastered scale, cost, software integration, and increasingly artificial intelligence. The same forces reshaping AI infrastructure are reshaping manufacturing, energy access, supply chain control, digital integration. In the AI era, manufacturing advantage is no longer just about precision. It is about systems. And systems favor those who can move fast, iterate rapidly, and scale aggressively. Legacy brands move carefully. Startups move brutally fast. Porsche now stands at a crossroads. To scale further risks, destroying exclusivity. To remain exclusive risks, losing relevance. That balance was always delicate. The EV transition made it unforgiving. This does not mean Porsche is finished. The company has reinvented itself before. Hybrid strategies, limited production models, refocusing on identity. But the deeper lesson remains. If even Porsche, a symbol of industrial discipline, can see its profit model collapse by 99%, then no legacy model is immune. This is not a warning to car buyers. It is a warning to industries. The world is moving into an era where software, artificial intelligence, energy economics, and geopolitics define value faster than tradition can adapt. Brands that survive will not be those with the longest history. They will be those who understand that the future is not mechanical. It is systemic. And the most dangerous assumption any company can make right now is believing that the rules that made it successful will continue to apply. What is unfolding at Porsche is not a failure of engineering. It is a collision between eras. The industrial era rewarded precision, control, scarcity, and incremental improvement. The intelligence era rewards adaptability, speed, software dominance, and systemic integration. In the old world, value was embedded in metal. In the new world, value is embedded in code. This is why the crisis at Porsche resonates far beyond automobiles. It exposes a structural vulnerability shared by many legacy champions. Artificial intelligence is not simply changing how products are built. It is changing what products are. A car is no longer judged only by how it drives. It is judged by how it thinks, how it updates, how it integrates with digital life. Navigation is no longer a feature. It is an intelligence system. Driving assistance is no longer optional. It is expected. User interfaces are no longer dashboards. They are operating systems. And operating systems scale differently than engines. This is where Western legacy brands face their greatest challenge. They excel at perfection. But perfection is slow. AI-driven systems evolve continuously. They improve weekly, sometimes daily. Chinese manufacturers understand this rhythm. They treat vehicles like platforms. They release updates like software companies. They iterate aggressively. They accept imperfection early to reach dominance faster. This approach clashes with decades of European automotive philosophy. But philosophy does not stop disruption. Markets do not reward elegance if it lags behind intelligence. This is why China's automotive rise is not an anomaly. It is a preview. The same pattern is unfolding across multiple industries: energy, artificial intelligence, semiconductors, manufacturing. In each case, the winners are not defined by who invented the technology first, but by who scaled it fastest, cheapest, and most strategically. This is why geopolitics now runs through supply chains. Energy access determines compute. Compute determines AI capability. AI capability determines economic leverage. And economic leverage determines power. The collapse in Porsche's profits is a microcosm of this shift. It reveals how quickly a dominant model can become fragile when the environment changes faster than adaptation cycles. The uncomfortable truth is that exclusivity alone is no longer sufficient protection. In a world where intelligence can be embedded into mass-produced systems, scarcity becomes harder to defend. Luxury must now compete not just with aspiration, but with functionality, and functionality scales. This does not mean heritage brands are doomed, but it does mean their margin for error is shrinking. Every strategic decision now carries higher stakes. Overinvest in electrification and risk overcapacity. Underinvest and lose relevance. Price too high, demand collapses. Price too low, margins vanish. This is not a Porsche-specific dilemma. It is systemic. And it raises a deeper question. What does luxury mean in an intelligent world? Is it craftsmanship? Is it performance? Is it experience? Or is it seamless integration into a digital ecosystem that adapts to you? The answer is still being negotiated, and that negotiation is happening in real time. Porsche's response suggests recalibration rather than retreat, a renewed focus on hybrid systems, limited production models, controlled volumes, preserving identity over scale. This strategy may stabilize the brand, but it also signals acceptance of a new reality. The era of effortless dominance is over. The future belongs to those who can integrate engineering excellence with digital intelligence without losing coherence. That balance is extraordinarily difficult. This is why what we are witnessing is not decline. It is transformation under pressure. And the pressure is not easing. Global competition is accelerating. Technological cycles are compressing. Consumer expectations are shifting faster than ever. The companies that survive will not be the ones with the strongest past. They will be the ones with the clearest understanding of the present. Because the most dangerous assumption in times of disruption is believing that success is permanent. Porsche's moment of crisis is not a failure story. It is a signal that even the most disciplined industrial giants must evolve faster than ever before. That heritage without intelligence is fragile. That precision without adaptability is vulnerable. And that the future does not wait for tradition to catch up. This story is not finished. Porsche may yet redefine itself for a new era, but the lesson remains. In the age of artificial intelligence and software-driven systems, stability is no longer guaranteed by excellence alone. It is guaranteed by evolution. And evolution favors those who understand that the rules have already changed. The collapse did not come with an explosion. It came with a sentence. Our business model no longer works in its current form. Those words may define not just Porsche's future, but the future of every legacy industry standing at the edge of the intelligence age.